As we look at the boards today, Friday, January 30, 2026, Datavault AI Inc., trading under the ticker DVLT on the Nasdaq, is currently sitting at $0.6827. We are seeing an intraday movement that has the stock down about 1.77% from the previous close, as the market processes a heavy mix of aggressive expansion news and the cold reality of share dilution. While the headlines suggest a massive rollout, the tape is telling a story of caution, with trading volume hitting over 14 million shares as investors try to find a floor in this volatile small-cap play. The general expectation for a company like Datavault AI is that they are just another microcap trying to catch the tailwinds of the artificial intelligence boom without much substance. Most people look at a stock under $1 and assume it is a speculative lottery ticket. However, the reality hidden in their recent filings is that the company is actually moving significantly faster than the market is pricing in, particularly regarding their 100-node network expansion across 33 cities. While the retail crowd is distracted by the daily price swings, institutional eyes are quietly tracking the company's pivot from a theoretical data platform to a tangible infrastructure provider with a revenue target of $200 million for this year alone. This creates a massive tension between the penny stock label and the scale of their operations. If you spend time on investing sites or tracking Tesla stock or Apple stock for stability, a move into DVLT feels like a different universe. But consider this. Datavault just closed its acquisition of API Media Innovation. They aren't just selling software, they are acquiring the physical and digital infrastructure to control how data is monetized at the edge. The common ground among investors right now is a fear of the 7.5 million share registration filed earlier this month. The contrarian take, however, is that this capital is being deployed into a network that the company projects will generate nearly $500 million in the second half of this year. We are seeing a classic battle between short-term dilution and long-term infrastructure scaling. When you look at the recent movement, the volatility is largely driven by the mismatch between these massive revenue projections and the current market cap. Earlier today, the stock saw a brief spike toward the 0.70 mark before settling back into the 0.68 range. This choppy behavior is typical when institutional activity starts to conflict with retail day trading. On platforms like the Robinhood app or through an individual brokerage, you see high turnover in these lower-priced names, but the volume we are seeing suggests that larger players might be using the sell-on news dips to build positions. If you are using SoFi Invest or a Fidelity trading platform, you've likely noticed that the bid-ask spreads on DVLT can get thin, which amplifies these intraday swings whenever a new press release hits the wire. The core of the business model here is something called the Information Data Exchange. Essentially, they want to be the clearinghouse for data tokenization. Think about how NVIDIA stock grew because they provided the hardware for the AI boom. Datavault is trying to provide the valuation layer for the data that feeds those AI models. They use patented technology to rate and detect content, which is why that partnership with fintech.tv for an AI content detection pilot was a bigger deal than the price action suggested. They are positioning themselves as a platform of platforms, trying to capture a piece of every data transaction in sectors ranging from healthcare to agricultural commodities. Comment below how many shares of Datavault AI you currently hold, or if you are staying away from small-cap AI stocks entirely this month. In the past, this company operated under the name Summit Semiconductor, focusing on wireless audio technology. That legacy still exists in their acoustic science division, but the total shift toward AI-driven data monetization is what is driving the current valuation. The older reports showed a company struggling with small-scale revenue, but the jump from $0.3 million to $1.7 million in quarterly revenue last year was the first real sign that the business model was actually scaling. Now, with the $150 million strategic investment from Silex Holdings on the table, the financial cushion is starting to look a lot more substantial than it did a year ago. The institutional activity is worth a closer look. While institutional ownership remains relatively low, the presence of analysts from firms like Maxim Group putting a $4 price target on the stock shows a massive gap between the current 0.68 price and where professional researchers think this could go. When you are looking for investment help or researching through Schwab Intelligent Portfolios, you often find that these microcaps are excluded from automated strategies because of the risk. However, for those doing self-investing, the risk-reward profile of a company targeting $2 billion in revenue by 2027 while trading at a sub-$400 million market cap is exactly the kind of setup that creates massive outliers. Looking ahead, the catalysts are very clear. We are waiting for the full activation of the edge nodes in New York and Philadelphia. If those nodes start showing the promised revenue flow in the upcoming quarterly reports, the market will have no choice but to re-rate the stock. The risk, of course, is execution. Building a nationwide network of 100 nodes is an enormous logistical challenge. If they miss their 2026 revenue guidance of $200 million, the stock could easily test its 52-week lows again. But if they hit even the low end of that range, the current valuation will look like an incredible mispricing in hindsight. Macroeconomic pressures are also playing a role. As interest rates stabilize, more capital is starting to flow back into high-growth, high-risk tech names. While big names like Nvidia stock or Apple stock are the safe havens, the alpha is often found in the companies that are providing the next layer of the tech stack. Online investing has made it easier for people to jump into these plays, but the volatility requires a level of stomach that most don't have. If you are using Interactive Brokers or a Fidelity brokerage account, you have the tools to set the tight stop losses necessary for a stock like this, which can move 10% on a single piece of news. The reality of Datavault AI is that it is a high-stakes infrastructure play disguised as a penny stock. The company is betting the house on the idea that data needs a decentralized, secure, and valued exchange to reach its full potential. The market is currently skeptical of that bet, focusing instead on the immediate dilution from share offerings. This creates a window of time where the expectation of failure is high, but the reality of their expansion is moving forward quietly in the background. Whether you are using the Robinhood app for quick trades or Fidelity Wealth Management for a long-term strategy, this is a ticker that demands constant monitoring because the narrative changes with every city they add to their network. To wrap this up, Datavault AI is currently caught in a tug-of-war. On one side, you have the intraday price of 0.6827, reflecting the immediate concerns of a market that has been burned by small-cap tech before. On the other hand, you have a company reporting triple-digit revenue growth and projecting a massive scale-up of their data monetization network. The expectation is that this is a risky, dilutive play. The reality is a company building an infrastructure that could fundamentally change how enterprise data is valued. The contrast between these 2 points is where the opportunity and the danger lies. Keep a close eye on the volume and the node rollout updates as we move through the first half of 2026. Would you like me to look into the specific details of their partnership with Silex, or perhaps analyze another AI infrastructure stock?